All right, today we are breaking down a professional's playbook. This is for trading one of the market's most chaotic events, the JOLTS report. Look, this isn't about gut feelings or trying to guess which way things will go. This is a cold, systematic protocol built for precision. Let's dive in.
Everything, and I mean everything we're about to cover, boils down to this single sentence. This is the core philosophy. It's the North Star that guides every single decision. It's all about discipline, not discretion. Burn this into your brain.
So we're going to walk through the 5 distinct phases of this protocol. We're going to mirror exactly how a professional operator thinks about the event. First, you establish the hierarchy. Then you prepare the battlefield. You identify the exact moment to strike, you execute flawlessly, and finally, you manage the position like a pro.
Okay, let's start with the most critical concept of them all. This is the absolute foundation of the entire system. It's the unbreakable hierarchy. Seriously, if you get this wrong, nothing else we talk about is going to matter.
This is the pecking order, right here, and it is completely non-negotiable. All your analysis has to flow from the top down. We start with bond yields, TNX, that's the ultimate source of truth. From there, we glance at the broad index, say the S&P 500, then the sector, then the US dollar, and only at the very end do we look at an individual stock. It is a strict waterfall of confirmation.
Now, for a rule that you cannot break, under this system, divergence is illegal. What does that mean? It means if you see the dollar index, the DXY, making a big move, but yields are just sitting flat, that move you're seeing in stocks, it's a trap. It's fake, it's unconfirmed, it's invalid, and the protocol demands you ignore it completely. No trade.
Okay, so we've got the hierarchy down. Let's move to phase 2, pre-event prep. You know, the success of any trade during a crazy event like this is almost entirely decided by the work you do before the numbers even hit the screen. This is where the trade is really won or lost.
Before the event, your chart needs to be mapped out with these specific levels. And these are not just random lines, okay? They are the key liquidity zones, the major reference points like the prior day's value area. They give you the context for what price is doing once the data actually drops.
Now, here's a huge filter. We need a catalyst to hit a market that's already in a state of imbalance. So if the market is just chopping around inside the prior day's value area, if it's in balance, like you see on the left, there's just no edge. The protocol says you stand aside. We need the market to be actively seeking value somewhere else, showing us clear imbalance.
And here is our energy check. Think of it like a volatility filter. If the market's daily range is just too small, it means there's not enough gas in the tank for a real high-probability move. On these low-energy days, we don't try to force anything. We just sit on our hands.
Okay, prep is done, charts are marked up. Now we enter the most critical window of the whole operation, the few minutes right around the 10 a.m. release. This is where your discipline will be tested. This timeline is your command center. At 9:55 a.m., you enter what we call the kill zone. That means hands off the mouse. At 10 a.m., the data is out, and your only job is to observe. The absolute earliest, the first second you are allowed to even think about a trade is 10:05 a.m., after the first wave of chaos is over. And the rules for this period? They're absolute. No entries, no trying to guess the number and jump the gun. You have to accept that the first 5-minute candle after the release is almost always just pure noise and deception. Your only job is to ignore it. Let the amateurs get chopped up. Okay, listen closely. This is the key that unlocks a real, valid trade. For any move to be legit, the bond market has to agree. The protocol needs to see one of two things from the TNX. Signal 1, a decisive break of its little micro range by at least 1.5 basis points. Or, signal 2, you see two clean, consecutive 1-minute candles, both pushing in the same direction. Without one of these two signals, it's all just noise.
So, yields have given us the green light. Now, and only now, can we move to execution. But before a single button is clicked, we have to run through one final checklist. Every single one of these boxes has to be ticked for a trade to be considered legal. This is your final pre-flight check. Let's go through it. 1. Is the 10:05 candle closed? Check. 2. Are yields confirmed using one of our two signals? Check. 3. Has a key structural level been clearly broken or swept? Check. 4. Is the sector ETF agreeing with the move? Check. And 5. Did we pass our daily volatility filter? Check. No exceptions.
Now, to keep this super simple and systematic, the protocol only allows two very specific setups. That's it. First, A reversal. Price sweeps a key level, sucks in a bunch of traders, and then reclaims it. Second, a continuation. Price reclaims the session's volume-weighted average price, the VWAP, and continues on its way. Anything else is off limits.
Think of this slide as your boredom firewall, right? These are the conditions that completely block a trade, and they're designed to stop you from taking dumb trades just because you're impatient. If any of these are true, the environment is just wrong, and the only correct action is to do nothing. Getting into a legal trade is really only half the job. I mean it. Professional operators know that how you manage the trade, that's what actually puts money in the bank. The rule couldn't be simpler. You get one trade. That's it. The protocol allows for one and only one attempt on this event. No second tries, no revenge trading if the first one doesn't work, no adding to a winner. You get one shot. Make it count, and then you are done for the day, period. And risk is managed with an iron fist. You're coming in at half your normal size. Your max risk on the trade is 1R, 1 unit of risk. Your minimum target is 2R. And as soon as that trade moves a good distance in your favor, that stop loss is moving to break even. This is all about protecting capital first.
This little decision tree just simplifies the whole thing. If yields move with conviction and structure breaks, you're hunting for a continuation trade. If yields spike and then immediately reverse as price sweeps a level, you're looking for a reversal. And if none of that happens, or if any of our block conditions are met, you stay flat. Simple.
And finally, you always have to be watching the clock. The main window to even put on a trade is just 15 minutes long, from 10:05 to 10:20 a.m. If you're still in a trade as 10:30 approaches, you have to get proactive. That's when the London market close can inject a whole new wave of volatility, and you need to be prepared. Let's just circle back to the most important idea of this whole protocol. You're going to see weird moves. You're going to see what we call ghost moves in stocks. The only thing that matters is this. If the bond market, the real money, cares about the number, yields will move. If yields aren't moving, it is noise. Full stop.
And we're going to end on this final powerful mantra. It's not about the economic number itself. Who cares what the number is? It's about how the market structure reacts to it. Your job is not to be an economist. Your job is not to predict. It's to wait, to observe, and to react with brutal discipline when the protocol gives you a clear legal signal.